Blind Squirrel Macro the Pod, our usual companion to our weekly newsletter. Squirrel coming to you on the morning of Tuesday the 8th of October Melbourne time. Quick reminder to make sure that you get the show notes for charts and links, and if you don't have them yet, fix that right now by signing up for free at blindsquirrelmacro.com. But before we start, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent. Talk to a financial advisor. Now, this week, the squirrel is touching the stove again and revisiting that thorny topic, Tesla. Now, the rules on equity research independence have evolved significantly since I started my career in the finance industry. In the early 1990s, it was not unusual for the first draft of IPO pre-deal research reports, permitted for deals outside the US and therefore not registered with the SEC, to be penned from within the investment banking department by the very same team that had just written the prospectus. It made perfect sense. After all, the rockstar equity research analysts were far too busy pitching for the next banking deal. Elliott Client 9 Spitzer's crusade against research independence took place several years later. However, memories of bag carrying for Salomon analyst Jack Grubman on a tour of Asia as he lectured to the extreme discomfort of the accompanying relationship managers to the region's national telecom company management teams on how to be more like WorldCom in the early 2000s are seared into this rodent's memory. Fast forward to today. There's an old adage that if you owe a bank $10,000, you have a problem. But if you owe that same bank $100 million, the bank has a problem. Now try a 27% share of a $13 billion loan to a quixotic billionaire to buy a website with which so many of us have a love-hate relationship. I am, of course, talking about Twitter. Pour a large one out for Morgan Stanley. Not only do they have to sweat about recovery on the senior loan against Twitter's fast depreciating assets, but they have also lent $12.5 billion against Musk's personal stake in Tesla. This margin loan is understood to be structured with a 20% initial loan to value and a 35% margin call trigger. Hey Siri, define concentration risk. ARK Invest's Cathie Wood gets her deserved, in my view, fair share of criticism on social media for her frankly attention-seeking share price targets for Tesla. These statements may or may not get her into hot water with her regulators down the line. Probably not. ARK's forecasts are typically constructed from a sum-of-the-parts analysis of businesses that are either charitably conceptual or, like Musk's AI and Grok initiatives, not currently owned by Tesla itself. Private Eye, the UK-based satirical and sadly stubbornly analogue magazine, is happy to call out grift emanating from both ends of the political spectrum. One of the Eye's long-standing columns is OBN, which this from Wikipedia highlights. Order of the Brown Nose is what it stands for. And it highlights the behaviour of those who have allegedly been sycophantic to those in authority, particularly in media and politics, such as Phil Hall, former editor of the News of the World, owned by Rupert Murdoch, declaring Rupert Murdoch to be the world's greatest living journalist. You'd have thought that the scar tissue from the fines of Client 9 would still twitch in the research compliance departments of all the major Wall Street brokerage houses, such that blatant OBN applications by senior industry analysts might raise multiple red flags. However, when looking at what emanates from one of Wall Street's preeminent banks and potentially the largest individual creditor to the Muskonomy, I'm talking about Morgan Stanley here, you have to imagine that with hindsight, Jack Grubman and Henry Blodgett, Merrill Lynch's internet analyst, might be beginning to feel pretty hard done by with their multi-million-dollar fines. Morgan Stanley's Adam Jonas has gone all in with his fawning Musk cheerleading in recent years. Value justification dispensed with mundane conventional metrics such as sales volumes and gross margins some time ago. That's just as well. Sales growth at Tesla has flatlined since mid-2022, and the company's acrobatics to achieve, might I say, very carefully managed consensus delivery forecast numbers at the end of each quarter are worthy of consideration by Cirque du Soleil. Not to worry, the automotive business accounts for less than 20% of Mr. Jonas's current $310 per share sum of parts valuation or price target. Idiots like this rodent apparently simply do not get it. Tesla is an AI and robotics company, not a car company. The squirrel stubbornly remains in the camp of, if it quacks like a duck, etc. We're now instead supposed to be wowed by the Tamanomics of Tesla as an autonomous rideshare company, aka Tesla Mobility. Now, I don't want to debate the merits of Tesla Mobility's potential go-it-alone strategy with respect to ride-sharing, i.e. without the network effects of Uber and the other ride-hailing platforms. Neither do I feel the urge to weigh in on the technical capabilities of Tesla's full self-driving software, which would appear to be not quite as competent as Waymo's or indeed some of the Chinese OEMs equivalent. It might also be tempting to nitpick at some of Jonas's eyebrow-raising unit economics assumptions line by line. I'm going to resist on that front too, but there really is some truly risible stuff, and I've put both his sum of parts valuation and some of the assumptions in the show notes. However, for Tesla Mobility to exist, surely the fundamental issue of ownership of assets and liabilities for this imaginary fleet of robotaxis must first be settled. Now, last time I checked, capital is no longer free, and someone also needs to shoulder the legal liability for £4,000 of unsupervised metal and plastic trundling around at 40 miles an hour. Not to mention liability for whatever a passenger might do inside that car after that one more for the road Friday night martini. If that's not enough, splash on some of Tinkerbell's pixie dust and dream about Tesla Aviation, a $9 trillion addressable market for drones and electric vertical takeoff and landing services, which could tack on, quote, up to another $1,000 per share to Adam's price target. All you have to do is think happy thoughts and believe. Since starting this publication, the squirrel has steered clear of the topic of Tesla and Musk for a number of reasons relating to both the billionaire's peculiar fan base. Do go and check out the comments from when I made the mistake of calling Tesla a car company on Jack Farley's Forward Guidance podcast back in April. And, of course, the failure of Tesla as a stock to comply with conventional laws of capital market physics and fundamental analysis. Sure, estimated gross margins have collapsed by 10 points in the past 18 months, but let's run up that forward PE multiple to 89 times. The squirrel has had a few wins on the dark side of Tesla, i.e. that is either short or being long puts, but has also experienced his fair share of scorched digits from touching that particular hot stove. This is because for every sneering headline from the suits, the non-believers, the he just doesn't understand tech, oh you just hate Elon crowd, there is invariably a wall of liquidity lining up to play at the hottest, well, at least it was until Nvidia came along, table at the Wall Street casino, namely low-delta Tesla call options. Next Thursday, October the 10th, we have the delayed from August We Robot event to unveil the latest plans for Musk's robotaxis. There will be no shortage of hype. The event even takes place in a movie studio, for heaven's sakes. Musk has a lot riding on it. To cite Brad Munchen in his excellent Motorhead Substack, quote, Tesla may show several mock-up models to excite its fan base. Tesla vans have been enduring a period that Musk explains as Tesla being, quote, in between two growth waves. It was clear that Musk announced the robotaxi day in a fit of rage after a Reuters scoop saying that Tesla had scrapped his $25,000 Model 2 EV. A friendly note this time from the squirrel. Never forget that any robotics expert worth his salt will tell you that any robot with anthropomorphic characteristics, i.e. humanoid or shaped like a dog, is created for the benefit of marketing and capital raising only, certainly not for reasons of utility. Anyway, back to those options. On Friday of last week alone, the casino turned over nearly 50,000 contracts, so that's equivalent to 5 million shares, or about $1.25 billion of notional value of sub 20% delta call options that expire the day after the We Robot event. The most actively traded teeny contract that traded on Friday was the $300 strike call option that expires next Friday. In order for these options not to be worthless before the market even opens on expiry day the following Friday morning, Tesla's stock needs to be up over 15% from Friday's close. Now, one charitable interpretation of this activity is that the buyers of these $300 calls are seeking to profit from anticipatory excitement ahead of the event on Thursday. More nefarious interpretations of this option trading activity are also available. Never forget that a relatively small amount of out-of-the-money call buying drives enormous volumes of delta hedge flows, i.e. the mechanical buying of the underlying ordinary shares by those market makers. Now, who on earth would want that to happen? The next 30 days contain one further risk for the Tesla share price. That is, of course, the US presidential election in November. This summer has seen Musk clearly align himself with the potential future Trump administration. The most recent rally in the Tesla share price has coincided with a stagnation in Trump's polling. But what could this divergence be telling us? Either this market is discounting the fact that a Harris administration will not seek vengeance for Musk's partisan pre-election activity, or instead, is it that the risk of Musk exercising his government sax clause, i.e. selling his Tesla stock tax-free so that he can take that cost-cutting job within the Trump administration, has that become more remote? Now, that would certainly be an extreme test of faith for the cult of Musk. Anyway, the squirrel touches the Tesla stove once again with extreme trepidation. However, the risk-reward this time is sufficiently appealing to pull this rodent off the sidelines. The game requires asymmetric odds and some very careful risk management. In Section 2 of this week's written note, we lay out the plan. Please check it out. Get that and more regular Smark at blindsquirrelmacro.com or find me on Twitter at squirrelmacro. Thanks again for listening. Squirrel out.